Right then, good afternoon everyone on Wednesday the 20th of March, and it is Fed Day. So we're going to have a look ahead to the Fed, what we're expecting to come a little bit later on, or I say expecting, what we're hoping for to come a little bit later on. So we'll start with a bit of a backdrop as to what to kind of expect going forward. I mean, or me, certainly what I'm hoping for going forward into a little bit later on this evening. So the Fed 6 o'clock tonight, as you can see, not the usual 7 o'clock with the clocks changing in America a week or two ago, and them that not being reflected in the UK time. It is 6 o'clock, so an hour earlier for us today. Now there is no kind of question as to whether we will see any cuts in today's interest rate decision. That is out of the question. What we're looking for is guidance, or some forward guidance on what to expect in terms of the path of interest rate cuts going forward. Now, if we have a look at some of the pricing kind of into the release, right, we can see certainly over the last kind of week or so, we can see your Aussie, Kiwi, Euro and Sterling all making their way lower. We can see dollar Swiss, dollar CAD, dollar yen all making their way higher. Gold hasn't really coincided with that, although it is slightly negative as we head into the Fed a little bit later on this evening. Equities are a bit all over the place, have been for a while. You can see the S&P, the Dow Jones, the Nasdaq, the Russell maybe a bit more bearish than the other three, but certainly these things are in a range, a pretty wide range, but certainly not trending anywhere heading into the release. And if you have a quick look at bond yields, you can see bond yields moving higher over the last couple of weeks, back end of last week, or kind of middle and back end of last week, and then into the start of this week on Monday, kind of grinding higher, into yesterday, and then into today, kind of grinding lower, making the way lower, and it's just a bit of a chop really. When we have a look at the 10-year yield, let me go up the 2-year yield, before we go on to it. Similar story though when it comes to the 2-year yields, bit of a mispricing there as you can see, but ultimately similar sort of thing to the 10-year yield. So yield moving higher into the release, not today and yesterday, but over the last week or so, moving higher in line with that inflation print last week, which we'll get on to in a minute. But US dollar, bit of US dollar strength over the course of last week and into this. Equity markets just range bound, yields higher last week and also relatively higher over the last week into the release today, right? That is driven then by previous week, as we can see here. Let's get it back to high impact. We can see inflation previous week. It'll want us. Let me get back. So we'll get the 12th on, so we can get the CPI print from last week, and you can see CPI out of the US, core CPI and just headline CPI. Actual 0.4 for the core month over month. Consensus 0.3, 0.4. Still too high. Core year over year 3.8 versus a consensus of 3.7, 0.4 in line with the total rate of inflation month over month. Headline rate up 3.2, up from the previous, up from consensus. So inflation remaining a bit sticky on Tuesday of last week. We then come into PPI, so producer price inflation. Previous 0.3, consensus 0.3, actual 0.6%. Now that is not really a situation where the central bank going to cut interest rates, right? You then look at the pricing into it. US dollars higher, yields higher. It's kind of a bit of an expectation, maybe potentially for a slightly more hawkish Fed. Now we can have a look at the CME's Fed Watch tool, which is kind of target rate probabilities for meetings out into the future. And you can see, 20th of March, 99% chance of no adjustment, which, is fully priced in, nothing to see there. May, you come around to May, 94.2% chance of no move in interest rates, plus then a 5.8% chance of a slight cut, now to 25 basis points, but pretty much 100% chance no cut into May. That leaves us then with June's pricing, right? Markets had anticipated the first cut from the Fed to come in June. We'll have a look then at June, and we can see a 60% chance of a cut, or we can read that in another way of of an interest rate cut in June being 60% priced in, 36%, not 3.6 in terms of two cuts. I'm pretty sure we're not going to get two cuts by June, and I think that is a universally shared opinion across financial markets. The issue is, though, do we get that cut in June? It's approaching the sort of time where they kind of need to, start letting us know, right? We're going to have one more inflation print by the time we get around to May. Time we get around to June, there's still a couple, one that we'll have kind of middle of May, one that we should get before the 12th of June meeting. But ultimately, having a look at this June meeting is the main focus of attention. Now, three interest rates, or we have a look at the dot plot. If we have a look at the dot plot back that we received back in December of last year, we can see the median estimate of interest rates come through to year end in 2024 is 3 steps lower than what it was the end of last year, which implies 3 interest rate cuts through to year end this year. Now, if we come back to the target rate, no cut in March, no cut in May, leaves us with June, July, September, November, December. That is 1, 2, 3, 4, 5 meetings, right? If we do not get a cut in June, that means they are going to have to cut interest rates 3 out of 4 times through to year end. We look at the economic data from last week, CPI accelerating, right? PPI also accelerating, right? Albeit CPI didn't really accelerate that much, but PPI, a massive beat on PPI in 0.6 versus a consensus of 0.3, right? So this 60% chance of an interest rate cut in June, you'd have to imagine is likely pushed back on. Do they push back on it in terms of vocabulary, or does the dot plot get downgraded to 2 cuts over the course of this year? Right? That means there is a substantial amount of pricing out to do if they go and tell us or communicate to us that there is going to be 2 cuts through to year end. You've got to fully then price this out, which should cause some pretty big moves in financial markets, right? I struggle to see a way where they continue on with dovish chat and just be like, okay, yeah, but, still 3 cuts on the cards. I mean, like, where are they actually going to cut 3 times or 2 times? If you take that out of the equation, like, where inflation is, with inflation where it is, with inflation starting to accelerate on the couple of data prints that we've had. We also look at the price of oil, and the price of oil trending higher. I mean, it got up towards 83. It has had a bit of downside over the course of today, but you look at oil kind of grinding its way higher over the December and then start of this year. It's back towards kind of 83, 82. If that starts to if that continues its way higher, I mean, you're coming back to a bit of a level here. Whether you're looking at the technicals at this moment in time or not, but it is grinding its way higher. The further higher oil goes, the more pressure it puts on inflation. And if oil continues to push higher, as I said, more pressure on inflation, more of a reason for the central bank to at least talk a bit hawkish. So there is some risks to the upside to do with inflation, right? That would then bring us back to have a look at this and suggest, well, is it really a wise idea from the Fed to continue on the path of saying we're going to get three interest rate cuts? It will probably be a bit more prudent from them to actually come out and say we're going to get 2 interest rate cuts to kind of keep a lid on inflation. If they can keep a lid on inflation, well, then that does allow them to cut maybe a bit more through to the back end of this year. So I do think the risks today are tilted to the more hawkish side, which is then the respective reaction would be yields higher, dollar higher, stocks lower. Then you got to think of what assets to hit, right? Straight away with yields, you can see gold has had a bit of a spike higher just over the last couple of minutes, which is, I don't know where I missed something, big upside in gold, which doesn't really go in line with what I was kind of hoping for in today's session. But if you think about it, right, you have a look at what markets to look at, right? Dollar yen, for example, straight away hawkish Fed, dollar yen. Bank of Japan disappointed on the further outlook for rate cuts, or rate hikes, should I say, going forward. That is, okay, they exited negative interest rates, exited yield curve control, but gave us no further update on whether further hikes are going to come after that. Right, that would then lean towards a more dovish central bank. If the Fed come out hawkish, it should be a pretty easy trade long dollar yen. Right, you then look at gold. I would have suggested gold before seeing this price. I mean, I do still think gold is probably a good trade to the downside, right? Because that should affect yields. A hawkish Fed should affect yields. And when you look at the price of gold, you think about how overbought that must be at this moment in time. Right, there should be a lot of people that are long, which need to exit gold. Longs. Obviously, an influx of gold longs being cancelled is shorts, right? So I do think on a hawkish Fed, short gold is probably a good trade. Right, you then look into tomorrow, the Bank of England, with inflation coming in lower across the UK over the course of this morning. Right, lower inflation kind of brings forward the prospect of interest rate cuts. Cable is probably a good short as well off the back of that. If they come in somewhat dovish and start to push back on interest rate, if they do talk about interest rate cuts and still say that there are 3 interest rate cuts on the table and they're happy to keep the dot plot where it is, you then look towards a more dovish outcome, and that's then where you hit equities, right? You look at equities, they kind of chop sideways, had a bit of a chop, and that is probably a reason to get long equity. So on a dovish Fed today, dot plot stays where it is. Kind of no comment on pushing back on interest rate cuts. They're still, accepting of interest rate cuts, and they say the spike higher in inflation is not likely to last. Well, then you get long equities. If they do note an uptick in inflation, and they do suggest that we may not get those 3 interest rate cuts over the course of this year, short cable, long dollar yen, short gold, I think is a good couple of trades to keep your eye on. So how markets move between now and the Fed a little bit later on is undecided. I mean, I would not have expected that spike higher in gold, which is a little bit annoying, but it kind of gives you a bit of a better price to sell at, I suppose. But yeah, we'll see how it pans out between now and 6 o'clock this evening. That's what kind of what I'm looking for, my expected reaction into this evening. We'll have to see how that pans out come 6 o'clock. But hawkish Fed, probably what I'm more leaning towards. Cable, dollar yen and gold are probably your assets of choice. Equities, your assets of choice on a more dovish leaning Fed. So let's see how that pans out a little bit later on. We'll keep an eye on it from now until then, but certainly don't go mad over the beginning few hours of this US session as we head into the Fed a little bit later on this evening.